Let me start with a single statistic that should stop you in your tracks. Silver has just printed 10 consecutive green monthly candles. 10. That is an all-time record. And here's what makes it even more incredible. They crashed silver from $120 all the way down to the lows, violent sell-offs, margin calls, headline shocks. And despite all of that, it's still green for the month. Think about that. Forced selling, liquidation, panic, and they still couldn't produce a red monthly close. That's not weakness. That's weight. Physical weight. The streak that shouldn't T exist. 10 consecutive green monthly candles. Doesn't T happen in weak markets? It doesn't happen when demand is fragile. It doesn't happen when buyers are speculative tourists. It happens when there is relentless accumulation underneath the surface. You can suppress price intraday. You can flush leverage. But if physical demand keeps absorbing supply, the candle closes green. And that's exactly what happened. China reopens, and the shortage is real. Now let's talk about something even more important. China just reopened after Lunar New Year, and what's happening on the ground is not theoretical. Multiple gold shops across China stopped selling bars entirely. Not delayed, not back-ordered, stopped. Contracts signed before the holiday are being refunded. When a seller returns your money instead of sourcing metal, that is not a forecast. That is a physical delivery failure in real time in the world's largest gold-consuming nation. Now layer this into price action. Gold held around $5,098 and even moved higher while China was offline for a week. It absorbed a Supreme Court ruling, policy uncertainty, a dollar bounce, all of it. And now China is back online. And they can't source physical metal. That's not bearish, that's combustible. The informed minority. Signal. Now let's look at positioning. Managed money long positions in COMEX silver are at their lowest level in 20 years, lower than 2008, lower than crisis depths. And silver just rallied 16% off its weekly lows. Let that sink in. The move has already started. And the momentum crowd is not even here yet. When speculative money eventually arrives to a market with 20-year low positioning, the move that already happened will look like the warm-up. This is what I call the informed minority phase. The crowd is skeptical. The data is constructive. Positioning is empty. That's where major trends begin. The dollar's 32-year signal now zoom out globally. The dollar's share of global foreign exchange reserves has dropped to 56.9%. That is the lowest level in 32 years, down from 72% at its peak. That's not noise. That's a structural shift. Central banks are reducing dollar exposure. Why? Debt trajectories, fiscal instability, credibility concerns. When reserve managers start reallocating away from dollars, where does that capital go? Gold. The demand math. No one talks about. Over the last 2 quarters, combined investor and central bank demand for gold has averaged 610 tons per quarter. Historically, only about 380 tons per quarter is required to drive roughly 3% quarterly price appreciation. We are 230 tons above that threshold. This isn't mysterious. Price is responding to documented demand that exceeds historical trigger levels. And supply? It can't flex fast enough. Mining projects take years. Permits take longer. The system is tight. Meanwhile, something else is cracking. Now let's move to a layer most people aren't watching. Private credit. Roughly $2 trillion in pension and insurance capital is tied up in illiquid private lending structures. Recently, a major lender managing about $273 billion restricted withdrawals from a $14 billion retail fund. That's a liquidity gate. That's stress. And private credit has been heavily funding AI infrastructure, data centers, high leverage builds, massive debt loads. If AI revenue growth fails to meet expectations, and the stress doesn't stay in tech stocks, it migrates into credit markets. Now look at housing. U.S. pending home sales just hit an all-time low, down 43% from peak. Contract closings fell more than 8% in a single month. The housing market is frozen. And gold volatility at its highest level since the global financial crisis. The market is pricing tail risk that hasn't fully materialized yet. This isn't one story. It's the same story told across markets. Silver's historic streak, China's physical shortage, 20-year low speculative positioning, dollar reserve erosion, private credit stress, housing freeze, different markets, same pressure. In part 2, we'll talk about why technical structure still matters, on the honest bear case risks you must respect, why silver miners are sending a signal, and the one question that should be echoing in your mind: if they crashed silver from 120 and it's still green, how much demand is really underneath this market? So we've established something critical. Silver just printed 10 consecutive green monthly candles. China reopened and can't source physical gold. Managed money positioning is at a 20-year low. The dollar's reserve share just hit a 32-year low. Private credit is flashing stress. Now let's talk about structure. Because fundamentals tell you what is happening. Technical structure tells you when it matters. Why technical structure still matters. There is a common criticism. Technicals done T-matter in a fundamentals-driven market. That's wrong. Fundamentals tell you direction. Technicals tell you timing. Recently, silver printed a bullish swing failure pattern around $72. It undercut prior lows, then reversed aggressively. That wasn't random. That was structure confirming demand. Then the inverse head and shoulders pattern formed. Left shoulder, head, right shoulder, neckline, breakout. It played out, not because of hope, because of order flow. If you can read structure, you're not reacting to headlines. You're anticipating where liquidity sits. That's the difference between independent thinking and chasing narratives. The honest bear case. Now let's address risk, because every real bull market comes with violent corrections. Gold at $5,098 with crisis level volatility means sharp pullbacks can happen without breaking the long-term thesis. Silver just rallied 16% off its lows. That creates a pocket of short-term traders sitting on quick gains. One negative headline, one liquidity event, and some of them will exit. That's normal. Private credit stress has not yet produced a visible bankruptcy event. Until it does, institutional capital may continue rotating within risk assets instead of fully migrating into metals. And remember what Jim Rogers has said about commodity bull markets. They are the most volatile trends in finance. They shake out the impatient, repeatedly. The miners are sending a signal. Here's something subtle. Silver mining stocks are only about 14% from their all-time highs, but spot silver is still roughly 44% below its nominal peak. That divergence matters. Equities often price future strength. When miners hold up while spot lags, it suggests the equity market is discounting tighter supply and stronger forward margins. That's not retail enthusiasm. That's institutional modeling. Gold versus the S&P 500 over 1 year. 5 years, 10 years, 25 years. Gold has outperformed the S&P 500 on every major time frame, yet mainstream advisory still largely ignores it. That disconnect creates opportunity, because asset allocation shifts slowly, and when it shifts, it moves size. The core question. Now let's come back to the simplest, most important question. They crashed silver from $120. Forced selling, margin calls, volatility spikes, and it's still green for the month. How much physical demand is sitting underneath if forced selling couldn't even produce a red monthly close? That's not a rhetorical question. It's a structural one. Because price only does that when supply is being absorbed relentlessly. One story, multiple markets. The physical shortage in China, the dollar's 32-year low reserve share, 20-year low speculative positioning, private credit stress, housing at all-time low sales, gold volatility at financial crisis levels. These are not separate events. They are one story told across asset classes, confidence erosion, liquidity fragility, structural reallocation, and capital quietly moving toward assets that are not someone else's liability. Final verdict. The data is public. The positioning is measurable. The inventory reports are transparent. Verify it yourself. 10 green monthly candles. China refunding gold contracts. Dollar reserves shrinking. Private credit gating withdrawals. Miners outperforming spot. This is not noise. It's convergence. And convergence is what precedes regime shifts. The crowd is not here yet. The positioning proves that. The headlines are mixed. The skepticism is loud. That is not what tops look like. That's what transitions look like. So I'll leave you with this. If they threw everything at silver, and it is still green, what happens when the pressure releases upward instead of downward? That's the phase we may be entering. Stay independent. Read the structure. Verify the data. And understand the market is telling a story. You just have to listen.